Okay, welcome everyone to today's webinar, Preparing for the SEC's Proposed Climate Risk Disclosure Rule. It is just noon on the dot. I'm going to give just a couple minutes for folks to trickle in. So we'll get started in just about a minute, but thank you all for joining us. Okay, that's a minute on the dot. I think that's fair to let some of the stragglers come in, but not waste the time of those who joined us on time. So again, welcome everyone to today's webinar, Preparing for the SEC's Proposed Climate Risk Disclosure Rule. I am Alyssa Rade, Chief Sustainability Officer of Sustain.Life. We are your hosts today. For those that do not know us, Sustain.Life is a SaaS tool that helps future-proof your business and helps businesses make decisions with the environment in mind. We help companies launch sustainability programs and build their decarbonization journey towards ambitious goals like net zero. We also help companies do things like measure their greenhouse gas emissions for voluntary disclosure and for this impending SEC rule. So I am joined today by two incredible panelists, Shiva Rajgopal and Matthew Gardner. I will introduce them both briefly, but then I will give them the mic so that they can do some justice to their incredible accomplishments and expertise in this space. So Shiva is the Kester and Burns Professor at Columbia Business School. Amongst many other areas of focus, he focuses on ESG implications for valuation, governance, and social responsibility. He is regularly featured in the Wall Street Journal, the New York Times, Bloomberg, Fortune, the Financial Times, The Economist, and he has a fortnightly column in Forbes. If there's a publication, Shiva is in it, so check him out. And we are also joined here by Matthew Gardner, founder and managing partner of SustainServe. They are a global management consulting that helps multinational companies integrate sustainability considerations into their long-term strategies and everyday operations. Their services include everything from benchmarking and trend analysis, risk and materiality assessment, stakeholder engagement, greenhouse gas inventory management, ESG analytics disclosure, the whole life cycle of ESG, and they are an incredible firm. Before I give them the mic, just a couple things, some housekeeping for today. We will leave some time at the end for Q&A. We're going to try to save about 10 minutes. So as questions do pop up, please do use the Q&A function, not the chat function. We will monitor the Q&A and we will do our best to provide clarity to your questions at the end. Anything we don't get time for, we will circulate answers along with a recording of this webinar and any other articles, or important resources that come up in the conversation to all of the registrants for the event. So without further ado, I will pass the mic on to our panelists. Shiva, Matt, please introduce yourselves.
I can let Matt go first. Alphabetical.
Okay,
a gentleman and a scholar.
Well, thank you, Shiva, and thank you, Alyssa. And thanks to all of you for joining today. Look forward to the conversation. My name is Matt Gardner. I'm managing partner, founder at SustainServe. We are a 20-year-old ESG consultancy based here in Boston, where I sit. Also have a co-headquarters over in Zurich, Switzerland, an office in Nashville, and an office in Frankfurt, Germany as well. And our work over the past 20 years has really been based upon helping companies think through the corporate sustainability, corporate responsibility, ESG, pick your acronym, landscape, and to help them understand what are the expectations from different stakeholder groups? What can the company do about this stuff in a manner that aligns with the corporate strategy and ultimately their value creation promise? And help them talk about it. So ESG reporting is a big part of our business as well. And so I'll pause there and hand it over to Shiva. But thanks again to everyone for being here today.
Oh, thank you, Alyssa, thank you, Matt. So I think Alyssa forgot to mention that my day job is that of an accountant. So I'm actually somebody who spends time worrying about measurement, reporting, and so on. And that's partly my interest in this area of ESG and climate. I'll just, start with some high level ideas on why I think this is. I started out as a big ESG skeptic, but the more I learned, I'm at least convinced that there is something here for two reasons. One, going back to income statements, we usually set the cost of natural capital of a company to zero. What does that mean? Broadly, soil, minerals, forests, water. If you start assigning even modest costs or prices to some of the natural resources that companies use, many of them perhaps may not be profitable, which is interesting. I mean, I don't know the precise cost of, say, carbon or plastic, but it's not zero. So I know that. The second issue is the reporting framework in general doesn't do a good job of dealing with externalities, which is just the jargon for saying, companies incidentally do bad things. They don't set out to do bad things. For instance, Coca-Cola is selling whatever, sugary water, but in the process, they are the largest seller of, or, consumer of plastic bottles. And half of that doesn't get recycled. So that's a classic externality. And financial statements do a pretty bad job of measuring that. And to be fair, they don't do a good job of measuring positive externalities. So when somebody innovates, by and large, they retain maybe 5 and 10% of the rents or the value from that innovation, and the rest of it just goes to society in general. Consumer surplus is another idea. For people who live in the New York City region, I often talk about this idea of Via. There used to be this service called Via that would take you anywhere in Manhattan for $5. Of course, they went bankrupt. But, now the same Uber ride costs us like $50, $60, $100, depending on where you are in New York. That 100 minus 5 is the consumer surplus that Via created. So businesses are very good at creating consumer surplus as well. So we ignore both these ideas. And that's why I think just big picture, and we can get into the weeds, ESG reporting and the whole idea of ESG is, I think, very interesting. And I can stop there and, maybe we'll get into some of the details with respect to climate as well. So thank you.
Great. Thank you. All right. So I love what you said, by the way, about financial statements doing a bad job of measuring externalities, because that is a problem, right? And I think that's part of maybe the impetus for this whole voluntary disclosure ecosystem, because it is about sharing those externalities and those benefits as well, right? But having a place where companies can talk about those things and share those things to stakeholders. And so I want to set the stage here a little bit on where this rule is coming from, why the SEC has proposed it, what's been happening before this, right? Traditionally, ESG, climate disclosure, has been primarily investor driven, also supply chain network if you've got your large companies with their ambitions, but right, it's primarily investor driven. And there is a reason why investors have been pushing companies to talk about and disclose this information. So let's talk about a little bit why. Why is it that they're asking for these things? What do investors need to understand as allocators of capital about how these criteria, and we can say ESG, but for this conversation, let's focus on climate. That's what everyone's here to talk about. Why it is they're looking for companies to talk about this information and what they do with it.
I'm happy to start. I think investors have been leading the charge in the sense that they recognize that their job as fiduciaries is to uncover sources of potential risk and to, factor that into their decision making as fiduciaries. And so, over the past decades, what investors have realized, I think what many in the scientific community has realized, what some in the business community have realized is that ESG factors, environmental, social, and some governance issues, do represent sources of potential risk. And it is, our job as business leaders, it's investors' jobs as investors and people charged with protecting financial assets, to uncover these sources of risk and to name them, to quantify them where possible, and then encourage the companies, to take steps to mitigate those risks. And so the SEC, as is kind of usually the case, the regulatory frameworks kind of march along it either closely behind or far behind, all depending what others have kind of realized for quite a while, that these ESG issues, or some ESG issues, may represent risk to companies. And if so, then they want to understand it. And the SEC is coming along for the ride and saying, if there is a material risk, a material financial risk within a company, then companies are obligated to talk about it. But that's my take on it. And so it's a natural kind of evolution of how, our perspective on these issues has a much wider angle lens on it now. And, let's roll these things in and have companies obligated to determine whether there are risks from these factors, climate in particular, but other sources as well, and then to make the case back to investors and back to regulators, yes, this is a risk, or no, it's not a risk. And if it's not a risk, why is it not a risk? So I see this as a very logical kind of continuation of how the corporate sustainability and the ESG world has been evolving over the past several decades.
Yep, and I totally agree. I spend a lot of time speaking about how climate is clearly an indicator, and climate, your risks and opportunities to climate-related impacts are clearly an indicator of long-term value and resilience of your business, right? If you're not strategically thinking about how your business is going to operate and navigate in the future conditions, which a lot of different things impact future conditions, but climate certainly does. I mean, we see in real practice today, what's kind of incredible about today is we do see real world observations of how climate impacts businesses. I mean, extreme flooding that's happening, right? In the US, in itself, you look at Florida and what just happened, in the Gulf, you see the real impact here. If you don't have a resilient strategy for, well, here's where my business operates and here's our, what our backup power is, here's how we're going to minimize supply chain disruption, here's how we're going to protect against this. It's, to me, a clear oversight in managing that risk. So I completely agree that, not to politicize this, because I do think it's so unfortunate that ESG and climate disclosure does get politicized, for one, to not recognize the clear risks that climate change does have on businesses because of our globalized world and our supply chain and what it takes to support our economies and businesses. It's nonsensical, to me, honestly. Like, it's somewhat incredulous and unbelievable to pose that argument.
I think that the magic step or the key step that we can take to depoliticize a lot of this is to give companies the opportunity to, in a credible way, to do that risk assessment. And if they feel that climate does not represent a material risk to their business or to their finances, and it is entirely plausible to me that there are companies for whom climate represents a modest or small risk, great, we'll give them the opportunity to make that case. I think where the politics come in is when people misrepresent the situation and say that, well, everyone has to do all aspects of this. And I don't think that's necessarily the case. You have an opportunity to make the case as to whether something's material or not. And if you're going to say it's not material, fine, let us know why, and then move forward from there. But I think that's an important caveat or an important mechanism within both the SEC regulations, but also ESG generally done right. Is make the case as to whether something's material or not, and then you can then decide whether to disclose it. And if it turns out that it is material or someone can prove you wrong, then you'll have some authorities to answer to.
So if I may add to this, so partly, I mean, the SEC is very late to the party, right? To be fair, the Europeans are far ahead, and that's good for us in the following sense, right? So if I were a small business in, say, food, agriculture or something, go pull up a report put out by, say, Europe's largest food ag business, and just read. They've done a lot of deep work. I'm in the middle of writing a piece where I'm trying to compare, say, AXA, the French insurance company, with AIG as a contrast, to just see how far ahead they are, at least in the thinking, right? And that's a role model. I mean, one of the, in my comment letter to the SEC, I had reproduced the, I think, was it Deloitte, the auditors discussion of the risk factors for British Petroleum. It's a very, very long list. So they go through, issues like impairment, transition, what does a scenario look like? Have we reached peak oil? All this was pre-Ukraine. But still, the very fact that somebody else has done a lot of the homework and has thought about all these issues in different industries, at the very least, I would say if you're a CFO or the board, identify a benchmark in Europe, look at their reports, ask your folks whether, do you think these are issues for us? And you might discover things that perhaps you may or may not have thought about, and that sets you off on a better journey towards understanding, to add what, Matthew was saying earlier about, are there risks we've not considered or thought about? Of course, what time horizon, etc. But the fact that the SEC is late to the party, to me, is actually a plus because we can learn from the others.
Yep. Great point. And I do want to dig into materiality because when Matt, when you first said that, my first initial question was, does that open up a loophole for bad actors to say, oh, we looked at this, it's not material to us? And what level of scrutiny or accountability do the informed shareholders and readers of this ultimate information, or what ability do they have to say, wait a second, seems like it would be material, like that doesn't quite sit right with us?
Sure. I mean, I think that will be a sandbox, a playground for future litigation. If someone claims that something's not material and shareholders or other, folks on the other side feel that it is a material risk, then there'll certainly be some conversations in some venue, be it a courtroom or be it somewhere else, about whether that's true or not. I mean, my experience in working with publicly traded companies, is that, people take SEC rules, CFOs, heads of investor relations, heads of public reporting, they take this stuff pretty seriously. And I think that, maybe I'm being optimistic, but I think that, that those folks in those positions will be fairly diligent and compliant with whatever the SEC is mandating here. I mean, it would take, you would be pretty gutsy to be in an industry where your peers and competitors are all saying climate is material, and then for you to say that it's not, good luck with that. If you've got a great team of litigators, who knows? But I think that, you're absolutely right that the art and science of materiality assessments, and we do those all the time, there's a variety of ways to think about it. There's a variety of axes, thinking about a materiality matrix. There's a variety of labels that can be put on the axes. But I think the definition of double materiality, as it's called, does this issue have an impact on you? Do you have an impact on the issue? Is a pretty good filter, and I think that'll catch a good bit of the issues, certainly climate, out there. So.
Great. All right. Well, we mentioned what this rule is requiring. So I'm going to put up this other slide, but let's talk about this. So we've got a high level summary here of what actually is going into this law. What has the SEC asked that domestic companies and foreign registrants include in their financial statements, right? And so it's basically 5 things. We'll also share in the comments and follow up with this. The SEC put together a very clear fact sheet that at a very high level summarizes this. So we'll share that with all the viewers, but this is what they're asking for. And we'll dig into each of these, but at a high level, they're asking companies to disclose climate-related risks that are actual or likely materially impact on their business strategy and outlook. So we'll dive into that question, materiality. They want to understand the governance of climate-related risks and relevant risk mitigation processes, which we'll chat about this, but one might argue, I think many have argued, that ESG is really all about governance, and it's just about what is it that you're governing, and that governance is really the most critical part of ESG, even though it sometimes gets the least airtime. I think increasingly, at least in the circles I'm exposed to, is getting more and more airtime. Number 3, the registrants need to disclose their greenhouse gas emissions, which will require assurance for large and accelerated filers. certain climate-related financial statement metrics related to disclosure in a note to audited financial statements. And then lastly, information about climate-related targets and goals and transition plans, if any. And that's actually a pretty big one. I think that's maybe the biggest one when we think about greenwashing that has the opportunity to combat greenwashing when we hear about companies going net zero already or climate neutral or carbon neutral. So let's dig into these. I do, just while we have all of these up here visually for everyone, you can't look at these and not think of the TCFD, right? So the Task Force on Financial Related Climate Disclosure, climate related financial disclosure. It's like you say the acronym so many times and then the words just jumble themselves. But this law, like most of the climate disclosure laws, is largely based off of the TCFD, which has been a voluntary framework that's been around for a couple of years that, again, investor driven, really, created and promoted by the investor community, saying, these are the things that we need to understand about your business. This is the only way that we can properly value and price in these risks, but also these opportunities. I just am fresh off a conference I spoke at in Toronto, this ESG conference, and the conversation we were having was all about how risks are really important, but ESG is in this critical inflection point where it's really evolving from just a conversation about risk and risk mitigation to opportunity and opportunity capture, because all of those things, it's kind of like the risks are like, they're a little bit of a drop in the bucket when you think about like the fines, the penalties, this, the that, like they're not good. But if you're going to be a resilient company in 5, 10, 25, 100 years, the opportunity capture of properly managing these risks and opportunities, that's everything. I mean, that's so much of what's going to determine your long-term value and ability to really, survive and thrive in future conditions.
I think that's exactly right. I mean, if you leave opportunity out of the calculus, then you're leaving money on the table, or potential money on the table. And I think companies and management teams are obligated to be thinking about both sides of the coin, because I agree completely, Alyssa. I mean, climate, just to use climate as the currency here, climate certainly represents risks and different kinds of risks for different companies, different geographies, different sectors, and all that. At the same time, there are opportunities for them to innovate, and to, leverage their positioning, leverage their technology, their people, and realize some upside from that as well. And so I think that's, a really important factor that, it should not just be a reactive compliance driven exercise, but I think it's really part, these kinds of assessments, this kind of reporting, or the process that goes into this kind of reporting can really be part of a good strategic planning exercise. And companies should be thinking in those terms, I think.
Yeah, and if I may, just boiling this down to brass tacks, the stock market is always looking for the next growth sector. Tech was good, but what's the next growth sector? It's probably green tech or climate, right? So on the upside is huge. That's one idea. The other, and I don't want to overstate this, but because we are in a university, we actually see your customers before you see them. And I can go on and on about balance sheets and income statements, and frankly, the students are not interested. But if you talk to them about climate or something, it just lighten up. It touches an emotional button, which actually kind of scares me a little bit sometimes because they're that emotional. But even if they retain some of that fervor when they graduate, the market for green anything in the future is probably huge. And more important, these people are going to be your future voters, citizens, politicians, businessmen, et cetera, et cetera.
Yeah. I again, one of the things I just spoke about in this conference was this crazy stat. By 2029, millennials and Gen Z, who, like you said, like we know that they care about ESG, we know that they are engaged on climate, are going to comprise 72% of the workforce.
Can I add one more statistic? Let's not forget the legacy wealth, right? So they're going to inherit a lot of legacy wealth, and I don't know how much that is, probably in the trillions. So even a tiny tilt of that money towards climate-friendly, ESG-friendly businesses is probably going to mean a big deal.
Yeah, agreed.
Yep. All right, I want to dig into each of these before I take this slide down so that everyone can see us. I do just want to talk about the TCFD, because I bet that there are a lot of viewers on the line who are familiar with the TCFD. It's been around, again, for several years. There's a lot of voluntary disclosure around this. It is the key framework that is kind of a common thread through the US proposed rule, involved in the EU disclosure, UK's proposed rule. I mean, this is really the common thread of the global regulatory landscape around climate disclosure. And so we won't go too far into the TCFD, but just to point out some of the distinctions between that framework and the SEC proposed rule, 3 things come to mind for me. Please feel free to add in. One of them, which we'll dive into, but is the proposed specification in this SEC rule about identifying, defining something that's financially material to a business as if it impacts that specific line item by 1%, because TCFD left financial materiality a bit ambiguous. It was just, if it's financially material, and it's like, well, what dictates what dictates if it's financially material? What's the threshold for that? So the SEC rule specifically proposed this 1%. The second one being scenario analysis, which the TCFD encourages, and the SEC took an interesting stance on this. And I would love to understand why. I don't know that much of the backstory to this, but said you don't have to do scenario analysis, but if you have done it, you do need to disclose it and you need to share it. And so what implications that has, like, is that creating friction for companies to be like, okay, it sounds like I'm not going to do scenario analysis because I'm not going to want to talk about it. And then number 3, requirements around who must report scope 3 emissions, which is probably the most significant distinction from TCFD, with this law basically saying, small businesses, don't worry about it. Large businesses, maybe worry about it. And if you have that transition plan or a stated climate goal, definitely worry about it, because that climate goal specifically entails the inclusion of scope 3. So you don't get to say you're going to be net zero if you aren't reporting on your scope 3 emissions.
I'll let Shiva comment on the 1% number. I know you've got some strong opinions about that there, my friend.
Yeah, I'm an accounting guy, and what maybe irks me a little bit is that they've never talked about materiality in a non-climate world. So this is an issue that's like pervasive, right? I mean, should you disclose something or not? Something as mundane as, say, doubtful debt reserves, or something else, litigation, estimates. So they've never actually told us what they think is material. That's been a matter of contention even in the boring old world of financial reporting. So it's quite interesting that they came and said something here. Is just one observation. And the second, implementing that is wow, that's going to be really hard. Personally, I think they overdid this, frankly.
Yeah,
I agree with that. I mean, I think this is one of the hard parts, both of TCFD and also for this particular guidance, is drawing the clear, straight red line versus a dotted line versus a curvy dotted line between climate risks and impacts and financial performance. That's why when you look at companies' TCFD reports currently, not a lot of them really directly get after the potential financial impacts, because it's hard to do. It's hard to do with, in a manner that CFOs and others are used to doing financial reporting. I mean, they're used to doing financial reporting where everything is checked, double checked. There's clear methodologies. You can reconcile financial statements down to the dollar, to the penny. You do that with respect to climate risk and greenhouse gas emissions and all that stuff. It's hard. And so I think that this is an area where, it will evolve, I think, over time. And I think there will be some, there will be a lot of discussion about how to do this properly there. So I agree with your statements on that, Shiva.
Yeah. So if I may add one more thing here, I think if you just to kind of summarize and collate these comments, the disconnect between the expertise, the resources, and the work that goes into financial reporting versus sustainability reporting in the same company couldn't be, more different, right? These are they almost behave as though they're in 2 different silos. The classic example of this, there are several companies that are putting out their sustainability report for 2020 now. You can't do that in the world of financial reporting,
Yeah.
right? And so they're like, it's like a parallel universe that's, spinning away at a different pace. All that has to kind of stop and come together for all this to be meaningful. A lot of the disconnect now is exactly this issue. Oh, how do I link ESG to cash flows? Well, at the very minimum, if corporate groups kind of talk to each other a little bit, and there's a human capital issue as well. The world of accounting is full of, as Matthew rightly pointed out, buttoned down folks. I'm buttoned up because it's cold here, not because I'm buttoned down, but legalistic, precise, people. The world of sustainability, on the other hand, NGO types, climate activists, the great folks, but they don't necessarily have the human capital in terms of understanding economics, law, accounting, and frankly, we haven't even invested as much time into creating measurement systems for these things to talk to one another. And when that happens, I think there'll be some really cool implications. Yeah,
I totally agree. Go ahead, Matt.
I was just to say, I want to touch base a little bit on the scenario question, because I think that's a really interesting aspect to this. Yes, the SEC rules are a bit more fuzzy when it comes to thinking about scenarios, but I would argue that, doing a climate risk assessment, almost by definition, does have to have a scenario analysis as part of it. You're asking a set of what ifs. What if the world warms? What if we get our act together and put the regulatory, technological pieces in place so that we prevent warming from crossing a certain threshold? So I think almost by definition, I think that it is a scenario exercise. Yeah. Honestly, where I look at kind of some of the TCFD reports and processes that are out there, where I get a little leery is, if you're looking across multiple different warming scenarios, 2 degrees, 4 degrees, 6 degrees, 8 degrees, whatever, these are models. There are error bars associated with these estimations. And so, can we really tell the difference between what's going to happen at 6 degrees and 8 degrees or 4 degrees? When we're working with clients on climate risk assessment stuff, I like to think in terms of this kind of, the world's going to get hotter and substantially hotter, or the world's going to, we're going to put the pieces in place so it's not. Let's think about that at first. Yeah. We can then certainly dive into some scenarios and think about, can we tease apart anything in a meaningful way between 4 degrees and 8 degrees or whatever. But I like to keep it cleaner, simpler, and just, and I think you get 99.9% of the actionable information out of that when you keep it simple like that. I think that's actually incredible. And throughout this whole conversation, I really want to ground clear points like that to our listeners on what tactically can they do. Like, there's all this legalese, there's all this legal jargon, and like, we're going to break this down and make this law accessible. But I think that's a really great point in terms of scenario analysis. First of all, what is it, right? But it's this hugely error-prone, inaccurate, unprecise, modeling exercise, essentially, to understand impacts with various degrees of warming. And like you said, can we really understand, and appreciate like what's going to happen at 6 degrees versus 8 degrees versus X degrees, I totally agree actually with this idea of doing a risk assessment. And when I first started doing TCFD, in-house for a business, that's kind of what the exercise was. It was this somewhat, like a little bit qualitative, but like thought exercise at the company to understand, like, okay, if, for example, we own physical assets and we own buildings and let's say you're a real estate company and you're paying the utility bill. If it gets warmer in the regions where we own assets, we will probably have to cool the buildings more. We will have to oversize cooling systems. We will have to pay more money to cool the buildings. If that is electric cooling, and we think the price of electricity is going to go up given, either climate change or, as we see today, like international and global energy markets, just understanding like, okay, what does that mean for our business? What's going to be the likely impact? And having it be this almost like narrative thought exercise to put the pieces together, like get it down on a piece of paper. And so I would say to our viewers on the line that's, approaching this from, understand the risks and opportunities to your business from climate change. That's what that exercise looks like, right? Like that's
breaking it down, that's what it is. Sit down and just think about it. Think about your business, you know, and what could potentially happen in future conditions from the risk side. And also, you know, what are some opportunities here?
So, you know, I can't help but comment, sorry for a minute. You know, the wonderful double materiality idea between the world of the CFO and the CSO, right? Here's what I'm saying. A lot of businesses, in my view, don't use scenario analysis even for their regular business. Forget the climate stuff for a minute, right? So if you're Facebook, you know, would we be around for a while? And you know what, you know, how will the world change? The young kids are going off into some other platform, et cetera, et cetera. So that's an example of double materiality that can actually help your real business. So bring this thinking of what ifs 30, 40 years out, you know, depending on how the macro world is changing, consumer tastes are changing, into your regular business. Everybody is better off because of that, you know.
Yeah, I totally agree, Shiva. I mean, for those who haven't dug into it, really interesting set of reading came out of Shell, actually, some decades ago. You know, the whole Shell scenario analyses, I think, are really inspirational, where they are, you know, as part of their business planning, but also just as part of their looking at the world, you know, spend a lot of time thinking about these what ifs. And I think it's, you know, it's kind of the genesis, I think, for a lot of the good, rigorous scenario planning exercises that happen. You know, I think where the scenarios are really powerful is, you know, less in kind of degrees of change, 2, 4, 6, 8, whatever, but really more when you start looking at some fairly orthogonal scenarios, you know, so you can think about, you know, what happens if the world warms, what happens across these different risk categories, what happens across different geographies, what happens across different technologies, things like that, or customers. I mean, that's where to, I think, focus your efforts. Again, and I personally believe that you can do it in a fairly simple way, thinking about warm versus not warm worlds, but you need to then cover the range of potential risks and opportunities that are out there, and
Yes.
and document them, you know, and think about the process and write them down, because once you've identified a risk or an opportunity, the next question that you need to ask yourself is, what am I going to do about it? Either to mitigate the risk or to leverage the opportunity that's in front there. That's the kind of analysis that I think results in really meaningful, strategic, actionable outcomes that a company can build on.
Yep. Okay. And so then my follow-up question, because I think conceptually we get it, right? Okay, I understand. This is what it means to actually look at risks and opportunities, climate specific risks and opportunities. What does this disclosure look like as the SEC has mandated it? Like, can this stuff remain in, you know, can't remain in an ESG report anymore? Where is this expected to appear on the financial statement? Shiva, I'm looking at you, financial statement guy.
Oh my God. See, so that's the legal like no man's or no woman's land, right? So people are happy putting stuff into the sustainability report because they think the SEC is probably not going to go after them as much as if, you know, if that were to get into the 10K, then we have a, you know, I'm no lawyer, but I'm not even sure that's true. I think you're responsible for everything you put out, regardless of whether it's in the sustainability report or the 10K. You know, maybe I'm going to dodge the question and probably talk about something else, which is look at some of the scenario reports that, you know, people have put out. Exxon, I was just looking at Exxon for a classroom exercise, just blows my mind, literally. No offense to whoever is on the call, but all they do is basically they say we'll carry on as before, which is fine, and you know their justification, they go back to Matthew's idea of look how big the ranges are between what the IPCC says and the IEA says, which is the, you know, and given how big these ranges are, this is part of the problem. You know, virtually every answer is okay. Is that the scenario analysis you want? Maybe not.
Yeah.
Right. So it's easier to figure out what's a bad scenario analysis versus a more honest one. And if it's going to be, and this is the other classic problem, right? It's called directed search in psychology. You make up your mind, then you go find evidence to support that. So this almost seems like one of those. You can make up your mind saying we don't want to change things, and then you can find all kinds of run phenomenal scenarios for 50 pages and basically say nothing. So I've seen a lot of those. So if somebody is interested in scenario analysis, again, I would ask you to do the simple thing, find a company in your industry, go study a bunch of these reports and just reflect on them. It's very, very helpful. It's cheap homework that could be, useful to you.
I think it also comes back to just how risk is assessed within organizations. I mean, classic risk management, what's the likelihood, what's the impact, or what's the likelihood, what's the potential impact of a particular, if something were to come true or to manifest itself. And so in a case like, what you're describing, Shiva, is that if someone is saying, well, we can't determine the likelihood, so we should take our toys and walk away from the assignment, is I think we'd all agree is foolish. And I think it runs counter to the whole concept. So if a company's response is going to be to question, to fundamentally question the premise of climate change and whether it's going to happen, then I don't think it's probably not worth engaging in the conversation at that point. The scientific community, I'm one of them. I spent years at MIT studying this stuff. The world is warming, the world is warming and the world is warming because of human impacts on it. And from the economic sector, I think that's incontrovertible. Now is what risk does that represent to my business? And, or if the world is going to change in such a way that it stops warming, what risks or opportunities does that represent to my business? We're obligated as business leaders and people engaged in this to have that conversation in a legitimate, credible, engaged way.
Yep. And I love that you just said we're obligated, because I think this tees us up for the next requirement of this SEC rule, but about governance, right? And how the business is managing this. So the requirement is what is the governance of climate-related risks and relevant risk management processes. So again, what does that mean? You just gave the example of, we don't like this, we're going to take our toys and walk away. Governance is all about implementing the structures and the processes from a corporate standpoint to make sure that doesn't happen, but basically make individuals, teams, disciplines accountable to properly manage this process. So what does this mean for companies, and how can they leverage their existing risk management departments, and what does this look like in practice?
So if I may, I would say, you need to upskill your board, if nothing else.
Yeah. Amen.
So, I teach a class on governance as well, and most boards have a particular profile, and I won't name that to kind of avoid offending people. But, many of them think that, and Matthew, I'm going to maybe disagree a little bit with what you said earlier, that this is a done deal. It's by no means a done deal. Just look at the Wall Street Journal. Most of the boards are effectively people the Wall Street Journal is talking to. And there's tremendous pushback about whether this is right. Some people would say it's an overreaction. So depending on the echo chamber you talk to, somebody will say it's a done deal. The others say, what is all this climate stuff? Is it even real, etc.? And these are the decision makers in the large. They control a lot of capital, whether you like it or not. So the conversation, I think, is still in progress, and it'll probably take a long time, but maybe that's a better way to get to this. So anyway, so that's one issue. The other, figure out some way to upskill it. I don't want to use the word educate, but upskill your board. Think about, where does climate fit into the larger picture for your company? And maybe, as Matthew said, if it's not material, and if you've done a genuine assessment, that's totally fine. Think about integration between finance and, sustainability broadly defined. And, and maybe more tactically, just get some baseline assessments, right? For scope 1 and scope 2, assuming that's important to you. Scope 3 is hard, I understand. So from a governance standpoint, but there's a conceptual point that I want to throw out. There's always been this tension between, should we have specialists on the board or generalists on the board, right? Like cyber now, should we have a cyber person on the board? And there's always, the pushback often is, we don't need specialists, because if they don't understand the rest of the business, they actually become a drag on the board. So we can just hire consultants. And you need to figure out in your own company what that optimal trade-off might be. But stacking your board with a bunch of ex-CEOs is not necessarily a good idea, is all I can say.
From the governance perspective, I mean, the way I think about it is that, if you've determined that there is, an issue, let's say climate change or any of the other issues that fall under the ES&G umbrella, or even not under the ES&G umbrella, just business issues. If you think that there is a topic, an issue that is material to your business performance ultimately, then you are obligated as a company, or I would certainly encourage you as a company to build a governance system. So who's in charge? Who's accountable to performance against that issue? And so there's that. What are the guiding principles that you have as an organization to guide decision-making around these issues? These can be in the form of policies, governance guidelines, call them whatever you want. What's that? How do you collect data? How do you monitor performance to know that you're moving in the right direction with respect to these issues? How do you set goals? What happens if your performance drifts in a direction that you don't want? What is your corrective action process? It's all of these kinds of things that I think extends across material issues. And when we're working with a company on an ESG strategy or whatever, that materiality conversation, that governance conversation are two key components.
Yeah.
Again, if you've decided it's important, then you got to manage it. You got to monitor your performance. You got to do something about it. If you don't, if you're not in a position to do something about it, then just say why. Maybe you don't have the data systems in place at a certain time, or you're going to put it, it's not, the risk assessment says it's not quite as important as something else, so we're going to put it off for a year. That's a business decision to make. But, if it's material, it's material. That means you got to do something about it.
I love that. So again, like thinking tactically for those on the line, if it's material, develop a governance strategy for it.
Let me throw one more thing. Since we talk about governance, we should talk about compensation. So, Charlie Munger's idea that, if you show me a person's compensation contract, I can tell you how they'll behave. That may be an extreme caricature of the idea, but there is something there, So, KPIs, both at the divisional level, at the higher level, even if the financial impact of the climate KPI on comp is not big, maybe that's okay. It's still a signal. So maybe think a little bit about, do you want to tie compensation, at least for the senior folks, to some climate KPI?
Absolutely. I couldn't agree more.
Yeah.
And
I think
that's part of kind of best practice in the ESG world these days, is that that community has recognized the value of tying compensation back to ESG performance. And so I couldn't agree with you more, Shiva.
Yep. And just on the heels of that, thinking about tying executive compensation, and then again, like accountability of the highest levels of the business, I was going to ask a question around governance of like, what do you want this to look like? And Matt, I think you actually preceded that by saying, like, this is talking about who manages this? What do you measure? Why don't you measure it? What are the controls? Like, it's really going through, like, how is this properly managed? That's what governance means. And I think part of it is also who's accountable, who's in charge. Is this siloed? Like, is this staying siloed in a sustainability team or department, or is this going up to chief financial officer, chief executive officer, board oversight, special teams, representation from different disciplines or departments across your business? I think that's the one final piece of what do you want this to look like? You want this to show that it has broad coverage, and representation across your business.
It needs to, by definition. I mean, E, S, and G are wildly multidisciplinary, cross-sectional topics. Not all of them, but a lot of them are. And so you got to have, one of the big challenges for companies who are building E, S, and G programs is to overcome some of the reticence that exists in traditional companies. It's just how they've been structured over the years. So to build in that ability to communicate and collaborate across functional groups is essential. Yep.
All right, I want to get to the next requirement. It's one that's very near and dear to Sustain.Life, but for companies to measure their greenhouse gas emissions with assurance required for large and accelerated filers. So let's break that down for folks on the line. What do you have to measure? What can certain companies get exempt for? Where does scope 3 come in? let's give a little insight on what this is going to mean and how businesses, I think this is one of the many things that businesses need to start wrapping their arms around right now, is making sure that you have access to this data and the ability to create these outputs, because these figures are going, we'll talk about scope 3 and where that winds up. For those on the line, we had a little pre-meeting ahead of this, and we were talking about the inclusion of scope 3 and how challenging, that really is. And how maybe, did the SEC overreach a little bit by requiring the inclusion of scope 3? It certainly is a lot to argue against for that. But I will say, again, I was just in Canada, their current proposal, and they're definitely, their securities association is definitely waiting to see kind of what happens in the US. Their proposal only included scope 1. So I was like, wow, like that, because you always compare the US to the EU and you're like, oh my gosh, we're so far behind. Like, we're taking such a more narrow, lighter version of this. But I did think it was helpful to see, like, Canada, what is going on up there?
Don't forget, Canada is primarily a mining economy.
Right.
Yep.
So in terms of, I think a lot, this regulation is going to drive a lot of companies, those who haven't done it yet, to do their initial inventories, to do their initial scope 1 and scope 2 inventories.
Yeah.
And when you think about it, scope 1 inventory, coming from mostly fuels that you burn, maybe refrigerants or some process emissions. Scope 2 emissions comes from the generation of, are the emissions that result from the generation of energy offsite that a company or an organization then uses on site. It's junior high school math, but it can be a accounting and data collection hassle. If you've got 500 facilities globally, each of which has 10 different electricity meters, or you're leasing part of an office tower in Manhattan, it can get complicated. Bottom line, though, is that it's relatively straightforward to do those assessments, barring some of the nuances here, and so what the assurance requirement is going to basically mean is just that you've got to be very, you got to go back to primary data sources, and the truth is probably is in most cases, it's going to be the invoices that you get from your energy utilities about how much natural gas, how much fuel you used, how much electricity that you used. Mm-hmm. That's the truth. That's going to be kind of the stopping point. And then you need to draw just a very clear straight line connection between that primary data, your invoices and all of that, all the way through to the greenhouse gas emissions that you report on. What conversion factors did you use? What emission factors did you use? So that a third party can come in and verify that and say, yeah, you did it right. That's it. And so for companies who are preparing for the SEC rules, or just wanting, if you're preparing for the SEC rules, or just wanting to do a good job on greenhouse gas emissions, then simply really documenting the daylights out of that process and showing people and using a good platform, Sustain.Life, something that can really just show that connection there is essential. That's just good math. That's how you do it. You want to be able to walk through it. It's like my 16-year-old son gets all upset when he doesn't get full credit on math homework because he didn't show his work. You got to show your work. That's the essence of this.
I love that. You're so right. It's about showing your work. That's really all it is. It's amazing. Now, I want to ask Shiva, assurance. Who provides assurance, right? And how comfortable is this profession going to be providing insurance, not for financial statement data or financial data, I should say, which, accountants are all about, but in translating that same process of control approach and processes, that is core to audit and assurance to this emissions data?
You're probably fairly far away from that, right? So if assurance was what Matthew talked about and we could stop there, it's easy. And that's what the market reflects. So right now you have a bunch of, I call them boutique assurance providers, to be polite. And, if you look around, they don't have lots of people working for them. The fees that they take are pretty tiny, etc. Right? So the big four will probably hesitate for one reason, the biggest one, litigation, right? So when will they get in? Eventually, at some point, I think they're trying to negotiate some kind of limited assurance kind of world with the SEC, where they don't get, they can capture the upside, but don't have to deal with the downside kind of idea, which is what I would do if I were them as well. But so they worry about. So I don't know. I think that's an open market. If you are if you can provide reasonable assurance, take some liability, then I think it would be a much more credible signal. So right now, the assurance people in the climate space, they can't survive one lawsuit, in my view. They don't have the capital. So, one way to differentiate yourself, if you want to work in that space, would be take some liability, of course, appropriately bounded, and hopefully that'll make you a more credible assurance provider than somebody who's, just verified the audit trails and so on, which is fine. So that market's evolving, and if you go back in history, back in the 20s and the 10s, you had a whole bunch of auditors. Very similar things happened in the world of financial reporting, and then consolidation happened. Not necessarily good for the shareholder, if you ask me, because now we have 4 big assurance providers in that space. You could argue information businesses eventually become oligopolies because of scale, but that creates challenges in how to keep an eye on them, and et cetera, et cetera. Something similar is going to happen in the next 20 years in this space, would be my guess. Lots of consolidation.
Interesting. Okay. And so you mentioned liability, and that was liability for the assurers. Let's just spend a moment talking about the safe harbor clause for Scope 3 emissions that is in the SEC rule and what that means for businesses.
I think everyone recognizes that Scope 3 emissions, or calculating Scope 3 emissions, is hard. They are estimations with large error bars, no matter how you slice it. And so I think they're being practical and smart with this. They recognize that, there's 15 categories of Scope 3 emissions. Different ones are relevant to different companies. The methodologies to calculate them are different and varied in their accuracy and precision. So I can't imagine it having been pitched in any other way. If they had come in and said, you got to do exact Scope 3 emissions, people would look at them like they had 3 heads. So all that being said, there is an interest in companies understanding where in their value chains there are intensities, hotspots of greenhouse gas emissions. And there are methodologies that can give you that hotspot analysis, that can help you understand, is this particular category, purchase goods and services, is it equal to my own Scope 1 and 2, 10x, 100x, 1% of it, and there are ways that you can get at those numbers. And so I think companies, should be thinking about that as part of their overall climate management process. But I'm glad that the proposed rules have that safe harbor clause, because it's, if you're going to start suing people for having wrong Scope 3 calculations, there's going to be a whole lot of lawsuits out there, because Scope 3 calculations are really hard and treacherous. I mean, I have to just give one shameless plug, honestly, for Sustain.Life, but like that exact exercise of understanding which Scope 3 category is going to be material to your business. If that is something you need help with, come talk to us. That is what we do in our platform. But yeah, I think when I just think of the safe harbor clause, clearly necessary, and you can't hold company A liable for information that it's reporting. It took the time and effort to collect as best it could, but it had no control over the integrity or the process of the collection and measurement, essentially, of that information. And so that's all safe harbor means. It's, still like, we want to promote you to do this. We want to encourage you to do this. We also didn't say, why is Scope 3 so important? It's typically 85 to 95% of any company's greenhouse gas inventory. I mean, it is your emissions, so we get in this conversation about what's so challenging about Scope 3, but let's also ground it in why it's so critical and important. Great. Okay. Well, I know we only have 2 minutes left. I did say that we would leave time for questions. Oh gosh, now it's only 1 minute. We did get a great question. Let me just get through the list. I think we'll only probably have time for one, but it is this is from an anonymous attendee. Fear of recession seems to be slowing investors and companies' push to disclose more ESG metrics. Will the SEC slow down the push as well? And that's actually a fantastic question, because we meant to get to this and didn't, but the SEC has just announced that they likely are going to not make the initial timeline that they had set out for this rule, which was, I think,
like responding to the public comments by end of October and finalizing this rule by end of year for it to kick in 2024 for 2023 fiscal year data. So what do we know about the timeline today? 30 seconds each. What can we say here?
I can't read the tea leaves on it. I mean, it's been delayed, maybe in the first quarter, probably by the second quarter, we'll get some clarity on this, but it's going to be delayed a little bit. The fear of the recession bit, that may be a bump in the road. I think there may be some hesitation to introduce anything that's burdensome, particularly financially burdensome, if we're staring at some kind of financial bump in the road. I think the momentum towards continued and expanded disclosure around potential risks and opportunities, I think that is going to continue. And if it might, so even if it does slow down a bit because of a potential recession, I think that's, it will just be a pause or a slight delay in what's going to continue to happen, I think.
Mm-hmm. Shiva, any lasting thoughts? I mean, we didn't even mention this. You spoke to the SEC when they were gathering public comments. They called on you to provide your insights. So any last comments here?
Yeah, I mean, I'd agree with Matthew. I mean, the trajectory in general is probably going in the right direction, but there will be quite a few bumps. Three things. One, they've got 14,000 comment letters, and they have to legally read the ball and process them. It's non-trivially difficult to do that. Second, there was EPA versus West Virginia, which I'm sure people on the call can appreciate, and if not, just Google that. And third, even when the rule gets put out, I think it'll be instantly litigated, instantly. So hence my point that in the long run, maybe we're heading the right direction, but there'll be some short-term bumps. And fourth, I worry about, the next administration. But that's probably a subject for the next webinar.
We'll hold that for the next one. Well, we've gone a minute over, but I want to thank all of our viewers for joining us today. Thank you so much. We hope you found this informative. We will circulate a recording and a bunch of additional resources that we mentioned. I want to thank Matt and Shiva. Thank you both so much for sharing your incredible insight here for what was truly a really fascinating and informative conversation.
It's really
Thanks,
fun.
Alyssa.
Thank you.
Yeah, thanks a lot.
Thank you.
All right, everyone. Take care and enjoy the rest of your Thursday.
Bye-bye.
Bye.